Hi, my name is Jerry Yu, the Family Money Doctor. Welcome to my YouTube channel. Today we're going to be talking about how exactly accelerated benefit rider works. See, nowadays many of the life insurance companies, regardless it's a whole life or universal life, offer living benefit or ABR, accelerated benefit rider. See, this is a great rider to have within your life insurance policy. Sometimes the terms and conditions of this rider could be a little bit confusing, but the important thing to understand is the actual impact that these riders have on your life should you ever need one. A very close and personal friend who was very meaningful to me once bought a life insurance policy when he was 65 years old. And when he purchased his policy for $1 million, now he bought this policy for the normal reason a person might need life insurance. See, this policy happened to have accelerated death benefit rider on it, but it's not why he purchased it. Fast forward 5 years, he's now 70 years old, and two things happen. First, he's diagnosed with ALS. The second thing that happened is he's diagnosed with stage 4 cancer. Now, fortunately, he was able to beat the stage 4 cancer, but that's not how it works with ALS. And he realized that he only have about 3 to 5 more years to live. Suddenly, it dawned on him that he had purchased this life insurance policy that had something called the accelerated benefit rider. And ALS and cancer were one of those things that trigger this benefit. So he applied to the insurance company and they said, all right, well, you qualify. What we're going to do is we're going to accelerate to you $750,000 of the death benefit, and by doing that, you are going to get a check for $650,000. So he looked at this offer and he said, you know what? I have two options. One, I can wait until I die and my wife can get this money. Or two, I can take the $650,000 today and I can choose to live the best 3 to 5 years of my life while I'm still alive, and those memories will be priceless. And that's what he chose to do. He built the house of his dream, this huge house near the beach overlooking the water. And he lived the best 3 to 5 years of his life possible. And it's a fantastic story to show you the importance of why you should always have one of these riders on your policy. But the problem is, sometimes people get stuck in the weeds about something that I might have glossed over and that you may not even caught. You see, the insurance company accelerated to him $750,000 of death benefit, but he only got a check for $650,000. So you know, why does this happen? Sometimes when people are determining whether or not they want to buy one of these policies, they get stuck in the weeds over the portion of it and forgot the most important part, which is those priceless memories that he was able to have while he's still alive. Today, what I wanted to talk about is exactly why there is this acceleration and why that check is always going to be something less than the amount of death benefit that gets accelerated to you so that you can feel comfortable about how these riders work and purchase a policy that has one. So why is the check something less? Well, there's how it works. It's the benefit calculation. Let's say that you have somebody who's 50 years old today, and this 50-year-old right now, if he or she was in really good health, then the life expectancy of this person is going to be 36 years. So the insurance company is expecting them to live until age 86. Let's say that this person has death benefit of $1 million. Okay. The insurance company is not going to be sitting around on $1 million at his age 50 or her age 50, because the chance of that person to pass away are not very high. They know that it is 36 years away until the insurance company have to pay for that $1 million death benefit. What if something happened to this person? Now this person has cancer or stroke or blindness or organ failure or ALS or something that triggered one of these benefits that now this person qualified for it, and they say, hey, I wanted to receive this acceleration. The insurance company will do the underwriting or ordering the medical records and comes to a new determination of this person's life expectancy is age 62. So now the new life expectancy is only 12 years away, not the 36 years away that they were originally expecting. So the question I have for you is, if the insurance company is going to accelerate $500,000 of death benefit, what is the actual check that person is going to receive today? Well, here's how they work. And I'm going to say it in the simple way and a little bit more complicated way, okay? The simple way is to say that the benefit, the actual check, is going to be the present value of that future death benefit insurance company is going to expecting to pay in 12 years. So 12 years is the first number that comes into the equation. And the second thing is, if the insurance company doesn't give them this money, what is the insurance company going to earn on that money if they keep it? So let's say it's 5%. Okay, let's say the insurance company is earning 5% on the money. That's the discounted rate, 5%. The third thing is, what are the mortality charge over the next 12 years? So that's the third thing. So the more complicated answer is the actual check. The reason why they accelerated $500,000 of death benefit in his check is only for $350,000 is because the insurance company is giving them the present value of that death benefit. They are taking that $500,000, they are going to go backwards 5% for 12 years, and they're deducting that mortality expenses. See, this is as simple as that. See, this is how they determine how much that check is actually going to be. Now, one of the things that people can be nervous about is that the insurance company can necessarily tell you today when you are looking to purchase the policy, what the potential benefit amount is going to be, because they don't know. See, they don't know what your mortality is going to be, and they don't know what the discount rate is going to be, and they don't know what the mortality charges are going to be. But generally, this is how it's going to work. And these are the factors that determine how much you receive. But even if you qualify for one of these riders, it doesn't mean that you have to necessarily wanted to actually take the benefit while you're still alive. And here's why. Maybe you do, maybe you don't. But most of the time you do. But there are some things that you have to think about, and there are some things important to consideration that you have to take into the mind. The first thing you have to do is you have to file for the claim. You have to file the claim and get the offer. Let them do the calculation, and they will tell you exactly how much the check is going to be. Okay. The second thing you have to take into consideration is, what is the current death benefit? Not just what it is, but what it's going to be used for. Does the death benefit need to be there when you passed away because there's some liabilities that the death benefit is going towards? Or like the person I mentioned to you, can that death benefit be spent now while you are still alive in order to live the best life? So what's the other thing that you need to think about? The third thing is how much cash value you have in your policy. It's a little bit more complicated, but I'll keep it simple. If you have a very high cash value policy and with the least amount of death benefit possible, and you take an acceleration of that death benefit, a large portion of that death benefit is going to be a return of your own cash value. This makes it potentially more or less advantageous when you take the acceleration. So it's just another consideration that you have to think about. So that's just another consideration that you have to think about when you file for the claim. The last thing is, if I did a good job explaining this to you and you understand and how it works, then let's say that the insurance company does a new calculation. And let's say the discounted rate they're going to use is 5%, okay? And let's say that you could take a loan from your policy and they're going to charge you 5%. Then mathematically, there's no difference between taking an accelerated death benefit or versus taking a loan from your policy. So you might actually end up taking a loan because there's a little bit more flexibility versus accelerated death benefit rider. And the loan interest could be less than 5% or even a 0% wash loan. So there are all the things that you should think about. But the important part is, don't get lost in the weeds. I know I spend a lot of time trying to explain the intricacy of how this works, but it's not the most important part. The most important part of the story that I told you at the very beginning is that you have the option to take the death benefit while you are still alive? What if you have some sort of significant medical event and now you have hundreds and thousands of dollars in medical expenses? You don't have the money and you need the money in order to get the treatment that you needed. And to get the treatment that you needed in order to live, then you're going to take the accelerated death benefit. And that's the options that you have. Imagine the impact it's going to have on you and your family. Or if you have, for example, the story that I told you, you have ALS, and it's something that you can't beat, and you know you have this short window of time to live. You can choose to live the best few years that you have left to live and have these priceless memories, rather than waiting until you actually die for someone to receive that death benefit. That's the most important part, and don't get lost in some of these calculations about how they work. So hopefully this makes a little bit more sense to you. And I hope that the next policy that you choose to purchase has one of these riders on them. Thank you very much for watching this video, and we will see you at my next YouTube video. Thank you.